Hello guys and welcome to another video. My name is Mark, I'm an entrepreneur and property investor. In today's video, I want to talk about what I think is going to happen with property prices in the next 4 to 5 years. Now, I've been digesting quite a lot of headlines recently about economic activity, about the cost of debt, about obviously the interest rates starting to fall, and there are lots and lots of things that we need to talk about in this video that could paint a very, very good picture for house price growth over the next 4 to 5 years. Now, I'm going to cite a few different articles as well. I've got the Savills house price predictions to my left on my laptop, and I want to go through a little bit about what they're saying, and a lot of it makes a lot of sense, as you would imagine. Savills have a lot of very respected individuals who are experts in the field, so I would expect them to have their finger on the pulse. And today, we're going to digest that and go through a little bit about my thought process as well. So if you like this sort of video, if you like this sort of content, give this video a big like. It really helps me out with the algorithm, and subscribe if you haven't. Remember, if you want to book a one-to-one consultation with me completely free of charge, just click the link in the description, and until I've got 10,000 subscribers, and I think I'm about 6 and a bit at the moment, you can have a 15-minute free chat with me anytime you want about anything you want. So let's get into the video. Let's talk about what Savills have been saying and what house prices might look like in the next 5 years. So the complete headline here is the fall in cost of debt and improving economic outlook have created more capacity for house price growth. That's the headline. And I would completely agree. Bank of England have started to move on interest rates. The Fed is talking about cutting interest rates in September. Once that happens and debt starts coming down to more affordable levels, then the cost of buying these properties, if you're a mortgage holder like I am, it becomes much cheaper. Now let me give you an example. I have about £3 million worth of property. On that £3 million worth of property, I've got about £2 million worth of debt. I used to make about 10 to 12 grand a month, somewhere in that region. Today, I make about £2,000 or £3,000 a month, and that's if I have no major catastrophes. So the margins have been completely eroded by the cost of the debt. And it's not just investors like me that are suffering those sort of issues. It's people who own their own homes. It's people who are paying their mortgage. I've heard of mortgage payments going from $800 to $1,200, from $1,400 to $2,600. You know, we're talking about big increases in mortgage payments. And a lot of the average people are being squeezed so hard that is restricting the amount of money that's moving around in the economy. Now, we might read some headline figures such as GDP has improved, it's gone up by 0.7% this year, or something along those lines. But let's not forget that inflation over the last 2 years, or 3 years, let's call it 20%, has been eroded off the value of your money. So if 20% has been eroded off the value of your money, and the economy's grown by a nominal amount of a couple of percent, let's say, over that period, well, really, there's 20% less output. There's 20% less goods and services being transacted. It's just that the value of them have gone up. So I'm a big believer that whilst COVID was here and we did create this inflationary environment, well, of course we were going to, right? We printed a load of money, we put it into the system, we told everyone to stay at home and do nothing. Of course, it's going to create some inflation. Now that's behind us, and we are in a phase where the average person who's going out and paying their mortgage is being squeezed from every angle. And that cannot last. It just cannot last. There will be far more unemployment, there'll be far greater things, and the Bank of England have already started to take those steps to bring those mortgage rates down. Now, 0.25% might seem like nothing, and to me it is nothing. We're talking about going from nominal amounts of, like, I think it was like 0.5% or something in the past, up all the way up until 5.25. So the 0.25 cut is very, very nominal. But it does signal a direction. And most forecasts are now saying that mortgage rates are going to come down significantly. And in fact, I've just secured a fixed rate on 4.68% on a company buy-to-let mortgage. Now, if I'd gone back 6 months, that would have been 6.5%, not 4.6%. That tells you that even the lenders are betting that the interest rates are going to come down significantly. So what does that mean for us, and what does that mean in terms of house price growth? Well, if I have a look at this chart, Savills are saying that in the next year, i.e. this year, 2024, 2.5% growth. I think we're about there already. So pretty safe to say we'll be there or thereabouts. 2025, 3.5, 2026, 4.5, 2027, 5, and then 2028, 4.5. Now, obviously, when we're looking at forward predictions, I always like to refer to as this cone of certainty. You know, things that we can see really close to us, we can be really certain about, right? Whereas the further out we go in time, if you think about a cone, the more sporadic our outcomes could be because we don't know about any external factors that may or may not happen. So when we're looking at this, I tend to think that we've got a fairly high level of certainty of what's going to happen in 2024. We've only got 3 months left. We're running at about 2.5% house price growth. So safe to say it'll probably be about 2.5%, right? But if we go into the future, the further into the future, we need these external factors to get into play. Now, do I believe that interest rates are going to come down? Absolutely, 100%. I know of people who are in very well paid jobs, who are doing incredible things, whose mortgages have gone from 5, 6, 7 grand a month to 5 figures. And even those people who are on £250,000 a year are now really, really struggling. They're taking their kids out of private school, they're actually having to make sacrifices and cuts. Whereas if we took it back 3 years, that would be absolutely unfathomable to them. On the other end of the spectrum, we've got people who are going out, working hard, earning an average wage, and they are still being hit. So it just cannot continue. So in my mind, there's only really 2 outcomes, right? Everybody is screwed, or everybody's going to be okay. And I think we're all taking a little bit of pain today, but it's all going to be okay, because it always has been in the past. We have always navigated these difficult scenarios. Now, I don't think anybody wants a repeat of when there was lots of repossessions, when people couldn't afford their mortgages, high unemployment. I don't think that's necessary. And because it's not necessary, it won't happen. Now, as an investor who is taking a significant amount of pain at the moment, my borrowing is much higher than the average person. My interest rates are higher than the average person, and I am taking more pain than the average person, there's no question. And this is not a woe be me story, right? Like, I don't expect anybody to feel sorry for me. Well, you've got £3 million worth of property, you've got £1 million net worth just on your property side, you'll be okay. Yes, but I am feeling cash poor. And if I'm feeling cash poor and everybody else is feeling cash poor, that means the economy is going to suffer drastically. And I believe the warning signs are already there. When we look at places like America where job losses are already happening, and these are in high-tech, high-paying industries. So let me just run through some numbers with you because this might surprise you. In 2023, going into 2024, Amazon laid off 16,000 people. Google, 12,000. Microsoft, 11,000. Meta, 10,000. In 2024, so far, 84,749 high-paying tech-based jobs have been cut. 191,000 in 2023. And these jobs are not being created elsewhere in the same levels. These are high-paying, highly qualified roles. So whilst the economy looks fairly strong in America, the Fed is recognizing that interest rates are having a significant impact on people's lives. And they can see, the same as the Bank of England can see, a big effect on the economy, employment, and all the things that go around it. So let's bring all that information back to house prices. Let's bring it back to the savills report. They're saying 2.5% this year, 3.5%, 4.5%, 5%, 4.5%, 21.6% growth over the next 4 years we're talking now in terms of property prices. Do I think that's reasonable? Is that in line with my expectations? Well, if you look historically, house prices double every 10 to 15 years, something like that. That would be the time frame. I'm a strong believer that we're well on course for being just below that in this period of cycle. And my personal opinion actually goes a little bit further. I think that these are fairly pessimistic numbers. I think that with lower interest rates, there is a lot of appetite for borrowing and buying property. I know lots of investor friends who have got money on the sidelines who are waiting to jump in when the returns are better. And at the moment, they're just not there for them. So I actually believe that we've got much more upside. Let's just consider the 20% inflation conundrum. We've got 20% inflation, and property prices have risen over the last couple of years by a very small number. Let's have a look. What's the property price? If we look at this Zoopla chart over the last 10 years, we can see that property prices have increased from about 185,000 to 266,000 over the last 10 years. So that's an increase of what, 50 50 odd percent, something like that, over the last 10 years. There's no reason in my mind to doubt that property prices will continue to increase in the next 10 years. Savills saying 20% over the next 5, fine, maybe so. And then if you look another 5 years in advance, let's say that was 20%, well, once the compounding on all of that has taken place, you're looking at about another 50% increase. So the real question for most investors like myself, even though I'm feeling cash poor at the moment and asset rich, is how long do you want to give it? And my experience and the data suggests in property, forever, because it always goes up and it always comes good in the end. So I'm going to leave this video with that thought, that I'm a big believer that any time you can buy a property is the best time to buy. And the longer you can hold it for, the more money you'll make in the long run. I'm a big believer in property investing. It's where the majority of my assets are held, and I'm going to continue to be buying in 2025, 2026, and all the way up the next growth phase. So guys, let me know in the comments what you think of this video. I'll respond to every single one, and I will see you on the next one. Cheers, guys.